Navigating the investment seas, understanding the impact of fees and expenses on investment returns. Introduction. In the realm of investments, where every decision carries implications for the bottom line, the impact of fees and expenses stands as a critical yet often underestimated factor. Investors, from novices to seasoned professionals, are well advised to comprehend the intricate relationship between fees, expenses, and investment returns. This exploration delves into the multifaceted impact that fees and expenses wield on the financial landscape, shedding light on the nuances that can make or break the success of an investment portfolio. The weight of fees and expenses. Fees and expenses are the tolls investors pay for the management, maintenance, and execution of their investment portfolios. These costs can manifest in various forms, including management fees, advisory fees, transaction costs, and administrative expenses. While seemingly inconspicuous, these charges can accrue over time, exerting a substantial influence on the overall returns realized by investors. Consider a scenario where an investor allocates funds to a mutual fund with an annual expense ratio of 1%. Initially appearing modest, this seemingly small percentage can accumulate into a significant reduction in returns over the long term. As the investment compounds, the impact of fees becomes more pronounced, diminishing the overall performance of the portfolio. Consequently, understanding the weight of fees is paramount for investors aiming to optimize their returns. The erosion of compounded returns. One of the most insidious effects of fees and expenses is their capacity to erode the power of compounded returns. Compounding, a force that amplifies investment gains over time, can work against investors when fees are introduced into the equation. As fees are deducted from the investment returns, the base on which compounding operates is reduced, leading to a compounding effect on fees themselves. For instance, if an investment generates a 7% annual return and incurs a 1% fee, the compounding impact of fees can result in a substantial reduction in the final returns. Over an extended investment horizon, the erosion caused by fees can translate into a noteworthy difference in the ultimate value of the portfolio. Investors must recognize that seemingly minor fees can wield a magnified impact over the long term, underscoring the importance of fee-conscious investment strategies. Active management costs versus passive investing. The debate between active and passive investing introduces another dimension to the impact of fees. Actively managed funds, where portfolio managers make tactical decisions to outperform the market, often entail higher fees to compensate for the expertise and research involved. Passive investments, such as index funds, seek to replicate the performance of a specific market index and typically come with lower fees. While active management may promise the potential for outperformance, investors must weigh this against the higher costs associated with such strategies. Numerous studies have shown that, on average, actively managed funds underperform their passively managed counterparts after accounting for fees and expenses. Consequently, investors should carefully assess their risk tolerance, investment goals, and the impact of fees when deciding between active and passive investment approaches. The impact on retirement savings. For investors channeling their resources into retirement savings accounts, the impact of fees and expenses takes on added significance. Retirement accounts, such as 401(k)s and IRAs, serve as vehicles for long-term wealth accumulation, making fee-conscious decisions critical for preserving the value of these savings over time. Consider an individual contributing regularly to a retirement account over several decades. The compounding effect of consistent contributions is a powerful wealth-building tool, but this power can be undermined by high fees. A seemingly marginal difference in fees can translate into a substantial reduction in the retirement nest egg. Thus, individuals planning for retirement must scrutinize the fee structures of their investment options and seek low-cost alternatives to maximize the long-term value of their savings. Transparency and fee disclosure. Investors are increasingly demanding transparency in fee structures, prompting regulatory bodies to mandate clearer fee disclosure practices. Recognizing the importance of transparency. Financial institutions and investment platforms are now required to provide investors with comprehensive information about fees and expenses associated with their investment products. This move towards greater transparency empowers investors to make more informed decisions, allowing them to assess the true cost of their investments. Investors can now scrutinize fee disclosures, compare expense ratios, and factor in transaction costs, enabling them to choose investments aligned with their financial goals while minimizing the impact of fees on returns. Mitigating the impact. Fee-conscious strategies. Mitigating the impact of fees on investment returns requires a strategic and informed approach. Investors can adopt several strategies to navigate the fee landscape effectively. One such strategy involves a diligent comparison of expense ratios when selecting mutual funds or exchange-traded funds, ETFs. By opting for low-cost index funds or ETFs, investors can harness market returns while minimizing the drag of fees on performance. Additionally, regular portfolio reviews and reassessments can help investors identify underperforming investments with high fees. Pruning such holdings and reallocating resources to more cost-effective options can optimize the overall fee structure of a portfolio. Furthermore, investors can explore fee-only financial advisors who charge a transparent fee for their services rather than relying on commissions tied to specific investments. Conclusion. In the intricate world of investments, the impact of fees and expenses on returns cannot be overstated. Investors, whether embarking on their financial journey or managing substantial portfolios, must recognize the profound influence that fees can exert on the performance of their investments. By embracing fee-conscious strategies, navigating the fee landscape with transparency, and understanding the compounding dynamics at play, investors can fortify their portfolios against the erosive effects of fees, unlocking the true potential of their wealth-building endeavors. In a financial landscape where every percentage point counts, the astute investor remains vigilant, ensuring that fees and expenses are not merely costs but strategic considerations in the pursuit of long-term financial success.